Good afternoon and welcome to UglyDuck 2023. It has been a while that we haven't been in this forum. Actually, a lot of things have happened since we last have been in this group. We had a pandemic, we had the outbreak of a war in Europe, we had inflation rising up, we had an energy crisis to deal with. A lot of things that actually, each of which is sufficient to derail the financial markets and the venture capital industry, as a matter of fact. Yet, it hasn't really happened, this derailing, has it? At least not at the scale or not at the time that we expected. But still, it's probably fair to say that it's the first time that we are meeting in an environment where we are reflecting on our industry in a downside cycle. We haven't had this since the big financial crisis in 2008. And hence, it is probably a good moment to reflect, also because sometimes I do have the impression that the venture capital community is very close to the religion of Dalai Lama, being very much living in the present, living even in the moment, with very little consideration of what has been happening in the past, and possibly not enough consideration of what is ahead of us either. So let us take a moment to reflect on our industry, and I hope that at least all of us, we still do remember this fabulous year of 2021. That's not so long ago, right? And we have had in this year 2021, and let the figures do the talking, we had in 2021 quite remarkable results to report for the industry. We have been moving up and up and up for years, peaking in 2021 with returns of our top 10 funds having a cutoff performance of 96%. This was 18 months ago. Since then, we had end of 2022, where we saw a slight hint of a market consolidation. Well, over the last few weeks and weekends in particular, I've been digging through the data of EIF for you, seeing what's going on in the market now. And yes, this market consolidation is about to be confirmed. But if you look at it from the perspective of the bigger picture, we are merely back to the level of 2019. And I guess if 2019 and 2020 and 2021 had not happened, we still would be celebrating those figures, because that's something that we have been fighting for a very, very long time, to make Europe so prominent on the landscape of asset classes. So it could be a comfortable way out to say, there have been 2 years of exceptions in between. Basically, everything is still as stellar as it used to be in 2019. We are good to go on. But since we want to reflect on our industry, let us take a moment and look at those 2-3 years that happened in between, and what actually we can learn from that, and what is in store for us in the future. And that's what I'm going to take you through today, on the basis of a number of data cuts that I've done at the level of EIF's portfolio, but also dragging in data from other sources that we get on the industry. And I take this opportunity also to thank the colleagues at EIF that have helped me in getting access to this data in the first place, because they're very deep down in the storage of our servers. There has been Halle, there's been David, Paulo, Johannes, that have actually worked very hard to find data that actually fitted the narrative that I wanted to share with you today. And it needed 2 or 3 goes until this was actually the case. So let us take a view of what happened in these last 3 years. You remember we had this build-up of the returns up to mid-2021. And in 2021, I had this crazy idea of looking at what happened if, rather than excluding the most recent vintage years, that what we have typically done, because we wanted to eliminate the funds that are in the J-curve, right? That for the first 1, 2, 3 years don't deliver any returns because management fees hit and it takes time to create value. What if we added to that sample those funds that actually have been 40% or more drawn? Which in venture capital terms is very much a level of investment that you would consider being pretty advanced. And in doing so, actually, the performance figures skyrocketed. What had happened? If you add the vintage years 2019, 2020, and 2021, we are adding funds that are merely in the investment period, or at best in the middle of the investment period in normal terms, and yet they had this impact to show. Meanwhile, as you can see, we have given back most of this exuberance of those 2 vintage years in between. But still, I think it is important for us to understand what happened that we got there. And yes, we will dig into this in greater detail, but before we go there, I would like to show with you what is making the money in the return figures that we are still seeing and that are still attractive for this industry. You know that for EIF, it has always been a little bit of a race between the different venture capital categories that we are putting on. And it has been the case in the past that the life sciences portfolio in our books showed an overproportional presence in the top performing funds of our portfolio if compared to the relative allocation that they had in the overall assets strategy. In December 2021, when we looked at those figures, however, we needed to realize that life sciences funds have basically been almost wiped out by ICT and digital economy focused funds because of this increase in valuations that I've been just sharing with you before. Back in June 2023 now, the territory that has been given up by life sciences fund over those 2 years is reconquered. And today, we are again in the position that life sciences in our venture portfolio and top performing funds represents roughly twice the constituency that it normally would advocate for if you looked at it in terms of the asset allocation of our funds. Another important element that I would like to share with you, because it is dear to EIF's heart and also to the heart of many of you, before I dig into the exuberance of the last 2 years, is the performance of emerging management teams. If you look at the performance distribution between established managers and emerging fund managers in our top 50 top performing funds, we had the observation in 2020 and 21 that this hype market was largely carried by the results that have been delivered by long-standing blue chip funds in the industry. We are in 2023, And I'm happy to report to you that more than half of our top 50 top-performing funds in our portfolio are managed by emerging managers, which would indicate that for EIF, this is not only a very strong commitment to the policy dimension that we are standing for, but at the same time, a pretty attractive investment and business model. But I promised you that we would go back to what happened in 2019, 20, and 21. And yes, if we look at these swings that we've seen in the market, and the fact that 2 vintage years that shouldn't be in the sample of the analysis in the first place turned the results of the outcome of the analysis upside down, does justify the question of what were we thinking when we were investing in this market. Top 50 top-performing funds of EIF in December 2021. In December 2021, we had 46% of the top 50 top-performing funds being of the vintage years 2019, 2020, and 2021. Let us move on to March 2023. No more fund in vintage year 2021. And the sample 2019 to 2020 has retreated to 28% of the portfolio. What happened? Well, we need to ask ourselves the question of who stopped the music. And now I'm making this link to this topic of sustainability, right? We all do know that climate change is very dangerous for a big number of species on this planet. But climate change is particularly dangerous for one species on the planet, at least market climate change is, and that species is called unicorns. If we look at our portfolio in 12/21, we had 34 funds out of 50 having at least one unicorn in the portfolio. 107 unicorns in the top 50 funds altogether. 18 months later, 15 funds have still a unicorn in the portfolio. 36 unicorns in total. Quite a change. Now, what did this do to our portfolio? Well, EIF at the peak of the investment cycle had 178 unicorns in the portfolio. Today, we are down at 92. The average market value of the unicorns in our portfolio has reached 4.5 billion in the peak of 21. Meanwhile, the average has decreased by roughly 30%. But it is also remarkable that for the first time in over more than 10 years, the net asset value of EIF's venture portfolio has actually decreased. But more amazingly, this is the portion of the venture capital portfolio net asset value that was held in unicorns. And whilst at the peak of the valuation cycle, we had 45% of our net asset value of the entire venture portfolio held by just short of 180 companies out of a portfolio of more than 5,000, remember? 18 months later, we are back to 14% of our net asset value of the venture portfolio held in the 92 unicorns that are left. That is a change of dynamics. And it has actually translated into the performance of our different subsegments in the venture portfolio. Whilst life sciences used to be less exuberant in taking advantage of the upside of the market, it also was more resilient now in the downturn. But look at the change of the DVPI in our ICT portfolio. It went from 168 in 2020 to 221 at the peak in 21, and it is now dropping back to 179. And the jury is out where this is going to stop. Now, how is the market at large reacting to this? Well, one would say the market is reacting to it as we would expect it to react. Because whenever it's getting a little bit windy out there, we do know that investors are seeking safe haven. They're fleeing asset classes that are volatile, long-term, illiquid. Pretty everything of that applies to venture capital, right? And yes, the market has reacted heavily to this setback. You know about this very short-lived love affair that the venture capital industry did have with the phenomena of SPACs. In 2021, we had 613 SPACs coming to the market, raising $162 billion. And it was a time where SPACs, when they bought assets, could count virtually on all the money that they had accumulated, because the redemption rate at that point in time, in the first quarter of 2021, was roughly 10% in average. Want to see 2023? Here we go. 22 SPACs came to the market in 2023 and raised $2.8 billion. Redemption rate of investors at this SPAC stage, 95%. Can you imagine the withdrawal of liquidity that happened with this in the market? But let's look at the other interesting element, which is the IPO market, which I'm certain everybody of you is following closely. 2021, 1,022 IPOs worldwide in the space of technology and healthcare. 215.8 billion of money raised from that. 2023, 182 IPOs, raising 19.3 billion. Is this the beginning of a drought? Well, let us look at the inner circle of the venture industry. Let us look at each of you and how much money we bring together in this room to keep the system going. This is the amounts raised at fund level, amounts invested at company level, the venture capital dry powder, as we call it, which is the money sitting with funds and waiting to be invested. And you see that we had an increase in fundraising up to 2022 record year, end of 2022, despite of the first sign of the market contraction. We had a decline in the investment mood in 2022 already, but look at 2023. Fundraising plummeted, investment went down, but still the dry powder actually went up. But if we look at the indicator of the runway of dry powder, which basically is defined as the ratio between the capital available for investment divided by the invested amount of the previous year, which normally in a healthy industry should be around 3 years, because that gives you roughly the life cycle of an investment period of a venture capital fund. I know, you tell me that I am ready for retirement because 3 years, that was 5-10 years ago, now it should be 18 months. No, wait. This has been the past, but it also will be the future. But in the year 2022, we had this runway ratio dropping to below 2.5 years. But you see also that in 2023, it recovered, it went to 2.9, it almost scratched the 3 years. So all good. The industry is funded. The ecosystem for financing technology and innovation in Europe is safe. Not quite. Not quite, because the ratio didn't go up to 2.9 because the fundraising environment stabilized. It went up because the investment activity plummeted even more than the fundraising plummeted, adding to the available capital in the market. And what does this mean? Well, it means that in our investment cycle, we are going to have repercussions that become visible only in the future. Because the reason why this capital is not invested is because fund managers have become defensive in their investment attitude. They do not know in what valuation level they are buying into a company. They do not know how much money they need to support the companies. They do not know how long they have to feed them. Actually, they don't even know how long they have to feed themselves, because it's a question of being in the market until you can raise your next fund, right? And as we look at that, a vicious circle is actually triggered. First, it hits the access to capital for companies in the market. Then it filters through to valuation levels, and that hits exit proceeds. Exit proceeds hit distribution to investors. Distribution to investors slow down the investment cycle because investors use distributions to recommit to funds. Fundraising gets stalled. Venture capital managers become more defensive because they need to cater for more runway for their companies. And so on, and so on, and so on. And before we have really understood what is going to be the real impact of this chain that we're observing here, we are in the old debate again. Actually, this debate has already started because we are seeing the first articles flying through financial newspapers questioning the attractiveness of venture capital as an asset class. How deep is the market? Is it really an industry where you can make money unless you are really lucky and with every investment you make, you hit the top quartile? Is there or is there no correlation with public markets? What are the cash-on-cash returns? What's the liquidity? What's the investment horizon? And so on, and so on, and so on. The discussion starts again. How can that be? We have spent 2 decades proving to the world that venture capital is an attractive asset class, that it can deliver serious returns, competitive returns. And now the debate starts again. Why is that? Well, I'm sorry if I have to disappoint you, but I think that the fault for this might all be ours. When have you ever made an attempt to explain the value of your investment activity in real, tangible terms? Isn't it us, and I have to include EIF, that we are talking and bragging with the number of unicorns that we hold in our portfolio, that we use to generate hilarious returns, at least on paper? Think of yourself. How many times have you been going out for fundraising, showcasing the number of unicorns that you have in your portfolio? Or the potential unicorns? Or the almost unicorns? And have you realized how fragile your story is when we enter a market like the one that we are entering now? How many times have we made the effort of investing in companies that are really making a difference to a societal issue that was crying out for innovation to be solved, and have used this narrative to make the case for our track record? Now, imagine that you invested in such a game-changing company, one that solves a real big issue. Can you imagine what the policymaker that we are calling upon to create the environment that gives us the basis for a flourishing industry, or the investors that we try to attract to this asset class? Investors that are out there carrying the risk that is inherent to our different economic systems, be it healthcare risk, be it insurance risk, be it demographic risks, be it the dependency on all kinds of natural resources that are finite. Can you imagine how we would be looked at as an industry, how you would be looked at as a fund manager if you brought home exactly that narrative? And if we proved our track record on those terms? Now, imagine that in your investment activity, you did make, rather than making a bet on the short-lived glory of a unicorn, you made a bet on a really game-changing company. Take the next BioNTech, or Call it the next Google, or the next Amazon, or the next Apple, or something possibly more meaningful or more human-centric. Let's call it simply impact unicorns. That rather than piling up 1 billion euros of paper value, actually brought a difference to 1 billion of people and their lives. If we manage to make this difference, the narrative of our industry would be very, very different. I know that some of you in this room know this type of unicorn, but they don't talk about it. But many of us actually have the ambition of these unicorns at the core of their investment strategy. They do have this vision, but they don't have the means. Whilst many of us actually do have the means to go after those unicorns, but we don't have the vision. Maybe it is about time that we brought together those two perspectives. When we formulate our ambition, what does it mean? Investment success. Thank you very much.